For decades, the housing market followed a physical logic. Prices were determined by local supply, neighborhood demand, and face-to-face human negotiation. You evaluated a property, made an offer, and haggled over the terms. Recently, a highly specific irregularity began fracturing that system, appearing simultaneously in multiple major cities across the country. In several major markets, rents and home prices began ticking upward in near-perfect metronomic unison across distinct clusters of properties. They moved together, adjusting at similar rates as if they were part of a single coordinated block. In many of these neighborhoods, there were no sudden job booms to drive demand, and regulators looking into these spikes found no evidence of human landlords meeting in backrooms to fix prices. The data showed a synchronized movement that lacked any traditional economic explanation. The cause is a wave of centralized AI-driven pricing models. Large institutional buyers and property management firms have replaced human agents with software that tracks buyer behavior and social media activity to set prices at scale. When pricing is outsourced to a centralized intelligence, the market stops reflecting local human reality. The cost of shelter is instead dictated by an automated system optimizing for the highest possible extraction. To build these systems, tech firms fed AI massive datasets covering rental trends, consumer habits, and neighborhood sentiment. These models were designed to identify exactly how much a person is willing to pay before walking away. As these platforms gained market share, the software moved beyond observation. These models now actively shape market conditions by forcing price movements across entire regions based on their own internal projections. When one algorithm projects a demand increase, it raises prices to test the market. Other algorithms detect that upward movement and adjust their own prices to match. Prices rise simply because the machines believe they should. Once the algorithms establish a new high, they create an artificial floor. Even if fewer people are looking for homes, the software resists lowering the price, keeping costs high even as demand weakens. By prioritizing mathematical targets over local conditions, these systems decouple the cost of housing from the actual economic reality of the residents who live there. Predictive analytics has changed how properties are acquired. AI no longer just reacts to the current market. It anticipates which neighborhoods will become hotspots before any human buyer realizes it. Institutional investors use AI to aggressively buy homes in bulk, front-running the market and securing assets before individual buyers can even place an offer. A human family cannot compete with a system that processes thousands of variables and adjusts bids in milliseconds. The speed of the algorithm effectively locks ordinary people out of the negotiation process. In the rental market, these same tools maximize revenue across massive portfolios, adjusting rents dynamically based on competitor behavior and occupancy signals. This creates a phenomenon known as indirect collusion. These firms do not need to speak to one another or form a traditional cartel to achieve the same result. Because competing companies use identical data and shared mathematical logic, their systems independently arrive at the same high-cost pricing strategies. When the dominant players in a city use the same automated tools, the result is a synchronized pricing environment. The outcome is a mathematical lock on the market that keeps housing costs elevated for everyone. This influence now shapes the physical growth of our cities. Because developers rely on AI to predict future demand and yields, institutional capital flows exclusively toward neighborhoods with the most predictable data signals. This biases urban development toward high-return zones. Communities that lack strong digital data signals are often starved of investment, reinforcing and expanding existing inequalities. The 3D graph of this synchronized system reveals a significant risk. The same efficiency that pushes prices up can also accelerate a downturn. If consumer confidence drops or the data signals shift, these algorithms could simultaneously adjust in the opposite direction. A synchronized retreat would trigger a rapid price decline, moving with a speed and volatility that traditional market safeguards were never designed to handle. Regulators are currently struggling to oversee a system that evolves constantly and operates at speeds fundamentally beyond human oversight. The shift toward algorithmic pricing forces us to decide who should control the most important market in our lives, and whether a system optimized for profit can coexist with the human need for stable shelter. Machines optimized purely for profit now control the mechanics of the housing market, operating quietly and efficiently behind every transaction. The shift away from human-driven pricing has already happened.